So let's get started with another pair. Remember, if you like these videos, please do comment, subscribe, share if you can. If you want results in your trading, you want to learn from real pro multi-asset day traders, then you can live every day. We teach live on Zoom, and we'll give you our full method and video training to learn from as well. If you've been watching these videos, you'll notice I'm always in gains, no matter what happens in the market. And we're going to do that again today. I know that before I even start. Just because of the method we use, how we protect, how we manage risk, and our high hit rate as well from years and years and years and years of we're looking at candles, more or less. I'm letting the chart populate a bit. We'll run through some brief factors, as I sort of do this on each video. Keep it as simple as I can. The pound Swiss is, a fairly neutral to risk pair over time. It's not quite up there with the yens, where you'd have a lot of risk on larger monetary policy deviations, but we know the Swiss bank can, intervene in markets. The economy in Switzerland can be very strong, so there's various different things we can factor in. But I'm going to go for the standard sort of normal risk sizing I have on these videos. Of course, that would vary on your style, your skill level, the amount of assets in your portfolio, the assets you're trading, the risk balance in your portfolio. There's lots of things that will affect that. So I wouldn't just watch this and say, you know what, I'm just going to go and do that. Because there's a good chance you'll get it wrong and it'll waste a lot of time for yourself. The best way is to just learn with us every day. We've got a fantastic room full of, buzzing traders and many professionals as well. So you can see we've got several daily candles now printed. I'm going to go for a 1% max risk on the pound Swiss overall. So I'm going to aim to not go over 1%. All right. And that means at any time. And we'll do it based on my equity drawdown. Okay. So as soon as that hits 99,000, I'm 1% down. If you can stick within something like 1%, you've got pretty tight risk management rules. Now, I can't see what's happened just before this, and I don't know. Okay. This was 10 years ago now. I think, it's a long while. I might have started this actually in 2013. So 11 years ago, I was 14 years old. I wasn't trading. I was learning about markets, but definitely wasn't looking at the every single day candle movement and all the moves in the day on lower time frames at that age. So I've shorted there just to kick things off. Like I said, I don't know whether the market's high. I don't know whether it's low. So I'm going to start off with fairly reasonably small sizes anyway. So the movements on Swiss pairs can be small at times. I'm just going to short again. Okay, so gain one there. And I will go on to the 4 hour. I think the 4 hour is a bit more beneficial for everyone to learn from. So I'm going to immediately hedge that short. I'm going to go for a 0.01. I'm going to kill that short. And now I've got a bit of a pullback, but I don't know really how valid that setup is going to be because of the price data. It looks like it might fail, so I'm going to kill it. How do I know it looks like it might fail? Well, this is telling me, you push down, come back up. There hasn't been any long side bias, and therefore, there you go. There's a bit more short side. So now you're getting some rejection on that wick. Remember, the purpose of these videos, I would say mostly, is to demonstrate what is possible. First and foremost, because a lot of traders use stop losses, and it harms them a lot. They really struggle. It is absolutely not necessary to use stop losses. That sounds taboo. That sounds backwards to some people. But, for us, the proof is in the pudding. Myself, my mentor, and his mentor before him have been trading without stops for a very long time with no problem. And I would really say, as long as you can understand price action rules to a high degree, get a very high hit rate, and you can manage risk and stick to limits, you really shouldn't have a problem. You should be sitting on a positive equity scale a lot of the time. So you can see now I've got these shorts wrong. They're out the money, but I've got the option to just add a hedge. Now my max size is going to be 0.1. As a general rule, again, just to help people understand. But you'll see if I take a 0.2 long there on 0.02, on this up move, okay, this growing momentum, then I've just hedged 2/3 of the former short area. So if it does pop like that, okay, I'm now out for gains. And instead of closing these for a loss, I've effectively covered some of my risk. And that allows me to add again higher up. And then if this falls, which it doesn't look like it will just yet, I can obviously add again, but I've got the option to hedge a very small amount at this high and then kill that for gains. So instead of stopping out, what's happening is my drawdown, yes, is growing, but I'm taking gains at the same time. So effectively, it's not true loss. It's not a true drawdown. And I've still got the option to add. So now we're a bit higher. I can just add another little piece. So I'm spreading out a max size of 0.1 over the larger spectrum of the market. The reason why is because Forex markets tend to swing a lot. For anyone who's wondering, this is Forex Tester 6. Okay, it's basically a simulated program, does quite well, and I'll reference it underneath. Okay, so we're moving up further. I'm going to add again. Now you'll notice that although I don't have stops, the sizes, because they're so small, my drawdown is only $104. Now note, we've already taken 38 in gains. So the real drawdown is actually my equity, more or less. My equity take off 100,000, which is what we started with. Now, because of the way Forex markets stretch, our hedging method is very, very useful because most of the time you're going to get some point where you get this big, big fold back in the markets. In other words, the bias of the market at the time changes drastically, and you end up with these falls. So at this point, I still haven't put 0.1 out, okay? And by the way, 0.1 is my max size overall. The reason why I'm spreading this out is because we don't have a lot of price data to reference because I've only loaded a certain amount of days so far, okay? So I've got the choice, do I want to add again? Now, because I've only got 0.01, 0.03, 5, 7, 9, I've got the option, well, where do I want to add? Now, effectively what I've done here is I put a size of 0.1 on an average of somewhere around here, 1, 4, 3, 5, 6, 7, something like that. So I don't really want to add another 0.1 until we've come up reasonably far. So maybe 200 or 300 pips, I can start adding again and building another 0.1. Now, for me, I prefer not to have, my 0.1 all at once. Again, the reason why is because of how far Forex markets can stretch. And remember, Forex markets, their movements are all based on sentiment, the mood of the market. In many cases, risk events, geopolitical or otherwise. You've also got, monetary policy decisions, interest rates, really the approach any central bank takes. Now, note as well, if we close this $8.46, that is also gains that will add on to my balance and thus my equity. So it's not just hedge gains that we can use to remove losses. It's also DCA gains, or in other words, positions put in later. Now, because the market is uptrending so strongly, my goal now really would be to try and find a hedge to put in, or a hedge zone. Now, this early support is going to be ideal. And effectively what I'm going to look to do, there you go, is start to hedge some of my exposure. So if I put 0.02 out and I've got 0.09 in play short, okay, I've hedged, sort of a small part of it overall. But it does allow me to cover my risk a bit, as you'll see. Okay, so now I've got the option to exit my shorts on a fall. It looks like the market's getting a bit weaker. Okay, so I can kill off this short. So that's reduced some of the exposure. And I've got the choice now, okay, well, shall I add it up higher then? I can do that, absolutely. And now what's happening is the market looks like it's turning to some south side momentum. So I can use the hedge gains I just took, they're effectively hedge gains. I can remove it. Now, the market is going higher. So in that instance, I might have been better holding my hedge. But equally, if it had gone south, I would have been better off. So I'm reacting really to where the market sits at all times, but I'm keeping an eye on my overall equity drawdown. And that's going to allow me to decide whether I want to add or not. So I might look to hedge again now if I get the chance. Now, because the price is still quite high, I'm just going to hedge a 0.01. And I'm going to add another one on a fall. I've got 0.02 in play now. And as I say on many of these videos, yes, the gains can be small on the hedges, but they do add up very quickly overall. Okay, now I can add another 0.02. So total exposure is going to be, if we count these overall, There's 0.02, 4, 6, 8, 10, and then 11. So I've got 0.11 basically over a spread of 1.42 to 1.48, almost 600 pips or so. So I can let the market run a bit, because if you look at my drawdown overall, equity drawdown sits just over $200 in minus, which really isn't going to be a big problem. Any fall under this, and I'm going to hedge long and exit that short I just took if we get it. So price looking fairly supported now. I'm going to kill that off. I'm going to hedge long 0.02. Any pop back to highs, I'll kill it. There you go. So $10 out there for gains. And I'm going to add another light short again. Okay, so you can see how, yes, again, $10 is only 1/26th or 27th of what the drawdown was at the time. However, you only need to do that 20 times and the whole drawdown's gone. Now, you don't close everything out at that point. You keep everything in play, but it gives you room to remove. If the market starts downtrending now, for example, I can remove that long I just took. Okay, and basically reset the position overall. So that's gains there. I'll look to add another long if we fall under this low, I should imagine. Okay, I'm going to add another short on that rejection, quite light short. There you go. Anything higher, again to the highs we didn't get. That's fine. Okay, market looks a bit weak now, so I'm going to hold off new longs. But I have accumulated enough now to clear myself. Okay, I've got a bit of momentum here. I'm a bit late on the long, so I'll keep it light. Didn't get too much there. I will add another light short. So I'm just teetering around, really. Now, I will take that for gains. I'll take that for gains. And what I'm going to do now is start to look for long side entries, lightly, because we're seeing a bit of momentum there, so I'm out. Don't want to add a short yet to hedge that former long. Any pop back, okay, I'm going to take a long here just because price looks a bit supported. Kill that for gains. And now I'm going to hedge short on this, long, early hedge short, kill it for gains. I'm going to get long. Any pop up and I'm out. Okay, fairly minor. Now, the price pop isn't very high, so I'm going to take 1/10 the max size because of the risk of being wrong. Out there for gains. The market is substantially more supportive at this point, so therefore I'm happy to buy again. Okay, now I'm going to kill this off, and I'm going to flip short. And what's happening is, we're accumulating gains as we come away from my former long. Okay, so out there again. And now I've got the option to basically remove either side. So I have to decide, really, do I want to take this long out or do I want to take this short out at the bottom? Now, because the market is trending to the downside and we could continue that way, I would probably favor removing the long here for $40. Okay, I'm still in net gains overall. And of course, now what I can do is I can add a larger long a bit lower. Okay, I'll keep it conservative at 0.03. And that means on any larger pop, okay, like that, I've already taken back half the money. Okay, which is decent, really. Now, because my last short is fairly close by, I'm going to take a 0.01. There you go, I'm out. This long might spur to something, so I'm just going to take a hedge long effectively. I would have liked to be out of that last short. I'm going quick enough. I'm not going to add again short because there's these shorts here. So market's still trending down. All right, still struggling a bit. Any real push to the upside, and I've got the option to add more short. So I'm going to kill that one. And what I'm actually going to do at this point, okay, so you can see the shorts I've got left. The market is really pulling down strongly. I could actually, if I wanted to, wash away number 6. So that for $10. So basically what that does is it leaves me with 2 positions left to the short side. All right, now, because we're getting a bit of long side momentum and the price is fairly low, I can take a slightly bigger long, just in case you pop, which you haven't yet. Now, this is where it would help to slow it down. I think I'll slow it down when there's going to be the opportunity to take reasonable gains. So price supported at this point, but still trickling more so to the downside with a bit of weakness. Equity going into positive quite easily now. I will play it because if you get a sudden pop. Okay, price fairly subdued still. I'm near to the shorts I took originally, so I'm not really interested in buying, selling again yet. I will now though. I'm only going to add a little bit because we're not quite far enough away from those entries. So now we're getting a bit of momentum. I'm going to take a 0.02. I'm going to slow it down a bit. Okay, just so we can see really where we sit at this point. So price supported again, so I'm going to add a bit more. And that helps as well with my short entries because now I've basically got no accumulation of drawdown. Okay, price teetering either way at this point. Any push south, I can exit those shorts. Any push north, I can exit the longs. Just speed it up a bit because we want it to go either way. So there I would have been able to kill those shorts, or that one short at least. That's the only problem with speeding it up. So you can see what's happening here very easily with my long and short lines. They're just telling you where the market is now channeling. You can see the top end is very resistive. So now I can just kill that. And because we're at the bottom end, I've got the choice, do I want to remove this? I will. And because I've taken gains, I can actually take another light short and just move it up. And because the market is ranging, right, there you go. I wouldn't be shocked if you come up anyway. But because I've taken these gains, the equity drawdown is still positive. So I'm able to remove those hedges quite comfortably anyway. And anything lower, I can look to buy. So market's still struggling a bit. You can see that. Now I'm going to add a bit more. I'm going to double what I had before. A bit more aggressive, but that's because we're at lows. Okay, there you go. Decent gain there. I can actually drop this to a quarter of the size because there's a bit of support there and a bit of momentum like that. Now what I will do is, just in case the market falls, I'll hedge. If it goes higher, I'll hedge again, but I'll keep it light. So still subdued, not impressive to the long side yet. Okay, I want to add now 0.1, very light still. Don't need to go crazy. There's no need to hedge massively because the drawdown is minimal anyway. Let things run. Okay, I'd rather be out of that. I don't really want to add long unless we get back to lows or lower than lows probably at this point because the price action over here is not incredible. Could trickle something in. Maybe we'll go 0.02 for a total 0.06 exposure. I'll add some more under the low. So now remember we had shorts all the way now. Our exposure now is all longs. So we've got 0.08 in play over a stretch of this. It's not bad. We'll get that to a max size overall. So my max size over an average price, fairly reasonable here. The goal more or less would be to work out of these higher ones if I can. Because I'm not desperate to short still, my equity drawdown is plus. I'm going to take a light hedge there. I'm out of that. Bit of momentum in the market coming, so I could add a light long again, just in case we continue, which we do. Kill that. Add a light short just to protect my capital a bit. Kill that. Let the market play a little. Kill that long. And now I'm happy to put the short hedge up a bit. So I'm now hedging half those former 0.02s. I'm out of that. Got a bit of momentum here of a very slight dip with some rejection. I'll get long. Anything lower, I'll add again. Okay, out. Light hedge to protect. Again, not massively necessary that I hedge, but it adds to my profits overall, and it does give me a bit of security in that those former longs I took start to fail, and we get dragged to lows again. for a multi-100 pip swing. Okay. So bigger pullback here and I'll be out of that head short I've just taken. Could have killed those longs really. I mean, I've got the choice to. I think over the long term, you'll probably get a bit higher. There you go. So I'm just going to close these and I'm going to start short side trading within this longer term move. There is very recent upside momentum. However, over the long term, you can still see a fall. Anything much higher again. So I can just take an early hedge here. And that's 1/5 of my exposure. So I'm not going crazy because the price is still very high. That was 1/20th of my exposure, that hedge gain. So not a lot, but I could easily take 20 of those as I have already. You know, it can be done in minutes. Still some momentum persisting in the market. Have that long. I'll add another to make it 40% of a max overall size. Okay, kill those for gains. And now we're seeing a bit more short side momentum. So I'm going to double on the former short size and see where we get. So a bit of downside movement there, not a lot. I'm just going to half the size because it seems waning just a tiny bit. And you can see, there we go. So out there, I can actually just kill that. And now I've got no positions. I'm $216 up. So I just continue the process again. I could take 0.03, a bit more aggressive because I've still got growing equity positive. Close that. Go for a 0.02 on this newfound south side momentum, downtrend. In other words, kill that. Don't want to add anything long until we get some space. That's nice, buy that. Any push to the lows and I'll get long, a bit heavier, a bit higher and I'll be out. Okay, that'll do it. Short that. Okay, I'll add. Again, and as I always say, you know, you would have a diverse portfolio here, so you would be getting more gains than this. And you could use those to protect if you chose to. But essentially, the point of all these videos is to display exactly what you're seeing now. You can see my shorts are going into drawdown. If I had a stop loss, I would be out. That'd be the end already. Okay, but with this, I can now add, you know, another 1/5 of max size and not worry about it. My equity drawdown is still positive. And the swing now, you know, it's coming up to 600 pips. It's a pretty long way. You know, I can add a tiny long to hedge some of that exposure, 1/6. Okay, that didn't get us too far, so I'll leave it. And I can always wash it out later. Okay, so again, not very big gains, but it does give us the edge. The reason why we're getting the edge is because those hedge gains are basically diminishing what we're losing overall. So it's like an artificial stop loss. You know, the drawdown is rising as the price goes away from us. However, we're not losing what we should be losing compared to someone who's using a stop loss because they are losing money, whereas we are not. Okay, we're now getting a bit of consolidation, so I can take a cautionary hedge, which I can wash with the gains taken overall later if I choose to. Another gain there, slight push above the highs, another short, gains there. I can take another light long just to protect. I'm going to go for a minuscule light long. Okay, so 1/6 hedge, not a lot, but it's enough for an edge. Kill that, and now because I can see weakness in the market, I can add another one perhaps, another cautionary hedge. And I can use the gains already taken to remove the former, just to bring it down at the average price, essentially. Bit of long side momentum, and I can kill that long I've just taken. Otherwise, we'll go south and I'll kill the short. Okay, so anything higher, and I'm out long on that hedge. Considerably higher, ideally. I'll tell you what, I'll just remove it now. Any push back in this consolidation, I can take that because there's a bit of momentum. There you go. Out. Add one light short, 0.01. You know, and I'm going to demonstrate really now how you would look to exit the cycle. And to exit any cycle using this method, you're essentially going to want to use the wash gains you've taken to close at an optimal price. Now, the price is far from optimal now because we've still got shorts below. But if I take that off, I've now got the option, do I want to kill these shorts? Now, because there's momentum there, I can get rid of that one. And anything, I can now pause, and basically anything lower, I can now just remove. So we're out the cycle, $256 in. If I wanted to continue, I could now take this long on the uptrend. Okay, so that'd be something like this. Okay, then I would exit, and I'd see where price goes, wait for something optimal, and you would just continue. I mean, the cycle, in essence, it doesn't have to end. It doesn't have to be the end of it. I mean, I and many of our professionals, many of our traders overall, run portfolios all year. So they don't end the cycle. The cycle never really ends overall. But yeah, I mean, if you want to end a cycle and just finish things off, you're essentially looking to just close out and stop trading, essentially. And then you can react to whatever happens afterwards. If you want to start the cycle again, you would just do what I've done short there. And you would probably find, if you've got a high hit rate like we do, you can see from watching this, I'm nearly always closing out profits, nearly always. And the high hit rate does a lot for you in a hedging strategy. Some of the gains, yes, are small. But like I said, if you take lots of them, they add up very easily. And if you're doing that in a diverse portfolio, you're in continuous gain. So you can see on this swing, 140 all the way up to 148, which is typical perhaps on a Swiss pair, and many other Forex pairs, my drawdown really, it only went to like a maximum of $240 down, and it wasn't even closed loss. So that's 0.24% on a $100,000 account. It is minuscule risk. Whereas if you're using a stop, you can be down massively and you don't have much control. So hedging is my preferred way. Again, I've ended up in net gains. Every single video I film here, I'm doing the same thing. It's net gains, net gains, net gains. So just watch them all. If you're serious, you can't just copy here and it'd be great and everything works. You need all the rules, the big video series. You need help from us, and we can teach you live on Zoom every day. If you're keen to get started, you want results, go underneath the video. See you in the next one, guys.